Hello everybody and welcome to Chapter 15. Does that really mean we have only 4 chapters left? Amazing. Anyway, looking at the learning objectives for Chapter 15, we're talking about compensatory damages. Compensatory damages are simply a repayment of an injured party for whatever loss he suffered. Simply stated, they try to make that person whole again, meaning that whatever loss they had, it would be rectified with money damages. There is a question then that says, well, how do damages differ when you're dealing with construction? And your text talks about 3 different types of breaches. One could be a breach by the owner. When the owner breaches, if it's before performance has even started, the contractor can recover whatever profits he would have made, but none of the costs involved, of course, of materials or labor, whatever. If it occurs during performance by the owner, then he can recover those profits plus whatever costs he has up to that point. And if it's after construction is completed, then he can recover the entire contract price plus interest. If, however, the contractor breaches it, again, it depends on when it's completed or when the breach occurs, but basically it's going to be the cost of having the actual project completed, if that happens to be. If the contractor does finish it but finishes it late, then the major damages would be whatever loss there was to the owner in that case. If there's a breach by both the owner and the contract, then the courts will simply attempt to strike a fair balance in awarding damages. The second learning objective talks about compensatory damages and consequential. The difference, well, compensatory we just talked about, they compensate for what you've lost. Consequential damages, those are those foreseeable damages that the parties that result from the party's breach. Foreseeable damages, they would know ahead of time. They differ from compensatory damages in that they are caused by special circumstances beyond the contract itself. In other words, they flow from the consequences. For example, if you buy goods that you intend to resell and they're not delivered through breach, then your loss would be profits, because that's kind of what you intend to make money from. When there is no financial loss, then you have what we call nominal damages, and in that case you simply generally sue for principal, if nothing else, and you'd be suing maybe for $1, and then just to prove your point. Number 3 talks about rescission and restitution, and we talked about rescission before. Rescission is where you actually just cancel a contract, and that's basically put yourself in a position as where no contract had taken place. Whenever you have fraud, mistake, duress, and undue influence, lack of capacity, or failure of consideration is present, then rescission is normally going to be available, but it may also be available by statute. Whenever you have a rescission, however, the rescinding party must give prompt notice to the breaching party. Restitution, when you rescind a contract, both parties must return whatever property goods they have previously conveyed. If they cannot be returned, then there would be a dollar amount placed on those, and that should be paid in place. Number 4 talks about specific performance. Specific performance is an equitable remedy, and that's where you actually make the person do what they said they were going to do. Now, it doesn't apply all the time, because if in a normal breach of contract, if money damages are sufficient, in other words, you could take that money damage and go out and rectify the breach, then that's what the courts will uphold. Specific performance is going to be applied when monetary damages would not be adequate. In other words, whenever you're talking about sale of land, for example, there's no 2 pieces of property the same, or if the goods are unique. For example, a rare painting, for example, money damages isn't going to rectify that, because you could not go out and buy that painting someplace else. In that case, then, the courts would allow specific performance. In other words, they're going to make the breaching party actually perform as he said. And the last one talks about the limitation of liability, and when will the courts enforce it. Well, limitation of liability means you're simply putting a limit into what you can lose if the contract is breached. Clauses that normally will not be enforced include provisions excluding liability for fraudulent or unintentional intentional injury, or for illegal acts or other violations of law. Clauses including liability for negligence can be enforced in certain situations, but not very often. So anyway, I think you're going to find that this chapter is not too difficult. Just keep in mind that even though it sounds like breach of contract is very, very common. Performance, of course, is the most common most common way in which contracts are ended, not by breach. Anyway, good luck with Chapter 15, and we'll see you in Chapter 16.